There are major signs pointing to a stock market crash. Not a fun topic. Imagine you started investing in 1998. The internet was exploding. Everyone thought they found the next trillion-dollar idea. Everyone was making money. Maybe not you. The dot com stocks were printing money. However, that was until the entire market collapsed in 2000. The NASDAQ plunged 80%. Fast forward to today. I'm getting that same feeling. And guess what? It's not just me. There are notable investors that are warning of a crash. One of them, Ray Dalio, who founded one of the largest hedge funds in the world, Bridgewater, has assets under management of $171 billion, has explicitly said the US stock market, especially large cap tech AI stocks, is in bubble territory. He compares the current conditions to the run up before other major historical busts, like the 1990s dot-com bust. He warns this bubble is driven by a combination of sky high valuations, excessive leverage, and a concentration of wealth rather than sustainable broad based fundamentals. We'll talk more about that. Michael Burry, the famous investor known for predicting the 2007 housing crisis, has resurfaced with warnings that the current market, especially tech and AI stocks, are also dangerously overvalued. He reportedly placed 80% of his portfolio in put options, which are bearish bets against Nvidia and Palantir, signaling his belief the shares can fall sharply. Robert Kiyosaki, author of Rich Dad Poor Dad, he's publicly declared that he expects a massive crash, warning that millions are going to be wiped out. He's advised investors to shift towards assets like gold, silver, crypto, rather than stay heavily invested to equities. Another notable investor, Jeremy Grantham. He's a veteran investor known for spotting bubbles. He reportedly warned of a deep market decline, arguing that valuations across equities are unsustainably high. And some of his past predictions have voiced concerns about super bubbles across stocks, bonds, and real estate all at once. So, the general consensus is overvaluation and concentration in tech and AI stocks, especially ones that have surged in hype, whose earnings really don't justify their price. Broad everything bubble, not just one sector, but a systemic overvaluation, housing, equities, bonds, alternative assets. Bottom line, economic fragility, unsustainable debt levels, macro factors that if things go wrong, it can have like an avalanche or a cascade of selling. So maybe this time is going to be different because AI, it's real. I mean, people are using it. But this time, AI could be the cause of one of the largest crashes ever. So let's make that comparison between the dot com and AI. Back in the dot com era, people were just throwing money at any company with a futuristic sounding name with .com. Stocks flew until they actually crashed. Again, the NASDAQ fell 80%. Most .com companies disappeared. Friends of mine lost millions. It was a rough 3 years from 2000 to 2003. The crazy part is the internet is the future, but all the hype with it created one of the biggest bubbles. So why am I bringing this up? It's very synonymous because the AI craze is starting to look very, very similar. We have the Magnificent Seven, which is, the Googles and the Microsofts, AI, breath like the Nifty 50 in the 1973 crash. Right now, there's only 7 companies that really control the entire direction of the stock market. Amazon, Apple, Meta, Alphabet, Tesla, Microsoft, Nvidia, the Magnificent Seven. They make up about 36% of the entire S&P 500. And if you own an index fund, you're also betting on these companies. Just put that in mind. They're spending absolutely insane amounts of money on AI. Tesla, $5 billion, Apple, $10 billion, Meta, $60 billion, Google, $75 billion, Microsoft, $80 billion, Amazon, $100 billion, $330 billion in 1 year. That's the GDP of Finland. So either they're right or they could be very, very wrong. There's a global AI race. It's not just about companies anymore. Countries are battling for AI dominance. US, China, and the IMF says nearly 60% of jobs in the developed countries are really exposed to AI automation. And whoever wins this race is going to reshape the world economy. But there's a darker side to all of this spending. I mean, things can get a little bit messy. Chip designers like NVIDIA and AMD, it's like almost like a catch-22. They sell the hardware to companies like OpenAI and xAI. Data centers like Oracle and CoreWeave buy the same chips, then rent out computing power to the AI companies. All normal, right? Until you see there's like a financial loop here happening behind the scenes. Microsoft funds OpenAI with $58 billion. AI pays Microsoft for the data centers. Microsoft uses that money to buy NVIDIA chips. NVIDIA invests back in OpenAI. OpenAI buys more chips. Oracle invests. NVIDIA invests. Money just keeps on looping and running around. Every company is booking revenue and profits all along the way. It's like paying your friend to dig a hole, and then he pays you to fill it back in. And then all of a sudden, you both made money. And then you decide how much. Is it 1,000 or 10,000? I mean, this cycle inflates valuations massively. NVIDIA is up 1,600% since ChatGPT launched. OpenAI is valued at $500 billion, but guess what? They only make $12 billion and still losing money. I mean, it doesn't add up. It's like the dot-com again. So the profit problem. Most AI services aren't generating enough profit to justify the valuations, but that can change fast. ChatGPT has 700 million weekly users. Ads can be enormous. I mean, companies can become dependent on AI tools. Prices could spike as dependency is locked in. I mean, AI companies could flip on monetizations, like that at any moment. But for now, most of their value relies on one assumption. AI progress must keep accelerating. And that cannot, it's not possible. It's just because it's going to hit a data wall. If you think about it, what AI does is it sucks up all the information. All AI has consumed almost all publicly available human-created data. It could be next year or the year after, it might run out completely of this data. It's a data wall. So if companies can't find new types of data, AI progress could slow down dramatically. Expectations could crash. And then again, you have the problem, inflated valuations could bust. Humans don't have this problem. We learn by living. AI can't replicate a lived experience. Scaling past the wall, this data wall, requires different data, not just more of it. So I'm going to ask you, is this another bubble? I mean, is the AI, the dot-com bubble all over again? Not exactly, but there's similarities. Like history, it rhymes. AI companies have real products and real value. But overvaluation, revenue loop, geopolitical hype, scaling limits, all the classical bubble signs are there. And but the thing is, no one rings a bell. We don't know exactly where we are. What stage? Are we here or we're here? Are we at the peak? So, I mean, I guess you're watching this to say, what should I do? Well, first of all, do what you think. I mean, I'm just trying to give you some information about what I'm thinking. And this is what I personally focus on for myself and my family. I'm going to keep on investing consistently. If AI is still early, today's prices could look cheap. Automatic investing into low-cost index funds saved me during the dot-com era and made me wealthy during the recovery. Invest in aristocrat blue chips that are part of everyday living. I mean, Johnson & Johnson, Philip Morris, Home Depot, Colgate, Procter & Gamble, Waste Management. People always have to throw their garbage away. And the next thing is increase your income. When you increase your income, you have more money to invest during the downturn. And during the downturn is when you make the most amount of money. Diversify. Never bet on one thing. Like, be diversified. My portfolio has stocks, bonds, a little bit heavier now, gold, real estate, and I said dividend stocks for passive income. Diversification is your safety belt or parachute during bubbles. So if this bubble pops, and it won't be the end of the world, there'll be an opportunity that you need to understand what's doing and do it in your circle of confidence, and don't have fear. And that's what I'm trying to do with these videos. So try to learn how to take advantage of a recession. These times are one of the greatest opportunities for wealth creation. Quality stocks will go on sale, and that's when you want to pick them up. So please don't forget to subscribe if you're serious about growing your wealth, and keep on watching my videos. I'm here